Hi there, and welcome to my channel Simply Stocks. And today I'm going to talk about Easytrip planners, which is looking attractive at these levels. Let's understand about the business and let's have a detailed analysis as to how the valuations are from a 2 years perspective. So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position to any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Easy Trip Planners, a small request, kindly support me on Patreon or YouTube. And once you get a $10 membership, you'll have access to my portfolio, my watch list, and number of podcasts that I put up from time to time. And also, you can get $100 upfront. You get 1 year access by paying for 10 months. For detailed market or company talk, you can directly email me, and we can work things out with a fee. And also, if you cannot pay on Patreon or YouTube, you can get the yearly WhatsApp membership by emailing me. Now, about the company established in 2008, it is an Indian online travel and hotel booking site, and you might be aware of this as well. Offers a comprehensive range of travel related products and services under the flagship brand Eats My Trip. Other services provided are holidays such as travel insurance, visa processing, and tickets for activities and attractions. Strong ROE and profit growth is pretty good, although the last quarter hasn't been that great, and that's why the stock has fallen. But around market cap of 9,000 crores, looking fine. If you look at the financials, these are Q2 numbers, September quarter numbers that I'm putting up at the moment. Sales went up by 140%. Profit growth was only 12%. So there was a lot of margin pressure this time around. It is a zero debt company. Low promoter but high institutional holding is there at around 40%. But due to the margin pressure and high cost, fuel cost, etc., eventually they ended up paying they ended up with a profitability growth of only 10-12%, and that marred the stock completely, and the stock has fallen around 40-50% from the top, although ROE remains robust at around 53% and margins at 47% looks pretty good. Now let's look at the results at a glance. So margins are down 10% year on year and remained stable quarter on quarter, and that is the major reason as to why the stock has fallen. Margins have come down from around 50% to 40%. The margins are nearly back to June 2019, which is fine. That from June 2019 till now, there have been a lot of pressure in the travel industry, so eventually margins are coming back into shape. Sales growth of over 30% from FY90s is commendable in a very competitive consumer market, in an environment where travel etc. did not do that well for 2.5 years, and reserves has consistently increased and are now up 2.5 times from 2020. Over the last 2-3 years, reserves have increased tremendously. Currently, it is trading at 25-22 times sales, which is on the higher side at the moment, and that is why there is concern that a stock of this pedigree is trading at 25 times or so. Should be trading less than that, but demand should come in from FY24 onwards as global economic and health environment stabilizes, especially from on the health front. Things are looking much better now, so hopefully travel should only pick up going forward. So numbers are set to improve, and it is a clear play on global and Indian economy and how people start traveling or enjoying leisure. So that, I believe, that is going to only pick up in the next 3 to 4 years. If you look at the revenue picture, so from FY19, from 101 crore of sales, we have gone up to 233 crores. That's a 2.2x growth in here. In terms of profitability, also from around 24 crores in FY22, we had a profitability of 107 crores. The issue has happened in this quarter itself when rise in costs have led to margin pressure. Otherwise, numbers were looking extremely good. So in terms of margins, from negative margins in FY19 to around 9% in FY20, it went up to 55%. FY22 margins were pretty good at 57%, but now margins have dipped to around 46-47%, and that is the biggest reason as to why the stock has fallen, because normally 200-300 basis points fall in margins of any pedigree company leads to massive selling in the stock, and here what has happened is around 10% is eroded. So now the margins, it looks like in FY23 will be around 47% or so. If you look at the sales segment wise breakup here, major sales comes from airlines and ticket booking, etc. So 98% of sales comes from there. Some sales do come from hotels and others, which were absolutely negligible this time around, as we'll see in the next slide. So this is the year-on-year product-wise performance for the company. In the air package space or air booking, ticket booking, etc., the growth was around 82%. But in the hotels and other space, it was flat or negative in all respect. And profit margins. Now the problem happened in the profit margins front. In the air package or air industry, the margins were around 37% versus 62%. So there's a huge dip of nearly 4,000 basis point in here. And hotels again, they had some contribution from hotels last time around. This time around there was nothing, and same with others. So that is the biggest reason as to why the stock has corrected, and nobody is looking to buy into it even now. If you look at the channel wise breakup for the company, then business to business is the basic, you can say, revenue generator for the stock. It's around 87%. Business to consumer is around 3%, and B2B2C is around 10%. So major business comes from selling its, you can say, products to corporates and businesses, and they have two packages and ticket booking, you can say, facilities in a group manner that they do for corporates, companies across the board in different industry verticals. So that is where they generate most sales. So some of the important pointers to keep in mind for the stock: it is ranked second in terms of booking volume and third in terms of gross booking revenue. For FY20, it did extremely well. It is the only profitable player in the last 3 financial years among the OTAs based on net profit margin. So the only, you can say, profitable company in this space altogether. It has the largest travel agent network of around 59,000 people. It has 4.2 million downloads as on March 31st, 2020, and registered a growth of around 64%. It would have dropped down a little bit, but things are looking brighter on that front, although margin pressure is there. The mobile traffic percentage is around 80% as on March 31st, again 2020, and the company's look to book ratio stands at around 5%. Look to book ratio is basically somebody who's coming onto the site and trying to book or looking to book, and finally books tickets, etc. It's around 5%, which is pretty decent. You can say, comparing to the industry standards, 5 of 100 people do book on its website. If you look at the valuations, so current EPS stands at around 0.6 rupees after the splits, etc. And expected FY23 EPS will be around 0.8 rupees. Currently, it is trading at 68 times earnings, but I think FY24 will see more traction in the numbers. So I believe a growth of 50% is very much possible then. So expected FY24 EPS could be around 1.2 rupees. So we could see the stock trade at a PE of around 70 by that time in the next couple of years or so. So the stock could trade at around 85 rupees. So one can possibly buy on dips and hold on to the stock for 60 to 70% appreciation in the next 2 years. So what needs to be done from a 3 year point of view? I believe it is a buy at these levels, and short term also it looks pretty good. 2024 should see traction in the travel industry, so looks like a consistent performer till 2025. What you can do is buy on dips to around 45 48 levels, and will look for 85 in the next couple of years. So this is a video on Easytrip. Please like and subscribe my channel and hit the bell icon so you can get my videos straight away when I post it. Kindly subscribe to my Patreon network. Thank you.